One of the biggest merger deals that I've ever seen in my lifetime is about to happen. Either Netflix or Paramount are about to make one of the biggest moves in media entertainment history as soon as the government figures out a way to benefit from it in some kind of way. Obviously, Warner Brothers stock has seen an incredible jump in their stock price as they are up over 180% year to date. And nearly 30% just in the last month at the time of this recording. And as this merger looms over the market and media landscape, I think we'll continue to see Warner Brothers stock fare well. But when this deal is done with Netflix or with Paramount, these are the top 3 ETFs that I believe will be heavily impacted by this deal. Doesn't mean that they will be the only ones impacted. Doesn't mean that I am totally right and you should take this information as a caveat to go and buy up a bunch of shares of what I'm about to talk about. It's just my opinion, y'all. Okay? ETF, of course, stands for Exchange Traded Fund, which typically houses a basket of stocks that make up its fund that have been handpicked by a qualified team of analysts and investors that they believe will provide a great ROI, return on your investment. Okay. First one up is ticker symbol XLC. That's Communication Services Select Sector SPDR Fund. That's a lot to say. That's why we're just going to say XLC. Okay. The next one up after that is FDN. It's First Trust Dow Jones. I can't remember the rest. I'm not even going to lie, but it's an index fund. Okay. And the third is GGME. Okay. Not to be confused with GME, which is the ticker symbol for GameStop, because God, please no, don't.
Stop.
But these are what I believe are the ETFs that stand to gain the most out of a successful merger deal at this very moment. It doesn't mean that, again, other stocks and ETFs won't also benefit from the merger. Let me make that clear. But now at the time of this recording, I do not own any of these 3 stocks that we're about to discuss, but I believe that they stand to gain much from a merger deal that goes either way. Okay. So we're going to go through all 3 very quickly to get an idea of what you're investing in. Should you consider adding any of these to your portfolio? First one up is XLC. This is an ETF that has 26 different holdings in it. Okay. 26 is not a lot, especially in terms of an ETF. It's very minimal. 26 different holdings with over 88% of those holdings being a part of the communication services sector of the market. I know a lot of people, when they hear the brand name of Netflix, for whatever reason, they associate it with the technology sector. And it's probably because Netflix often gets grouped with tech giants like Meta and Google and, companies like that. But Netflix primarily, if you really want to look it up, Netflix primarily operates within the communications services sector of the market. So remember that when you're searching for ETFs that have it within their portfolio, okay? It's going to be in that sector and not the technology sector. But XLC, adding Warner Brothers to their assets would mean that this deal would entirely change the landscape, okay, of that entire sector, because so much of their weighted distribution would shift to the communications services sector, which would in turn affect this particular ETF's performance going forward. Again, XLC. Interesting enough, XLC's top 10 holdings include both Warner Brothers and Netflix at number 4 and 5, respectively. So when we're talking about by weight, how much of these companies they're owned, their positions number 4 and 5. So they own quite a bit of both of these companies. Okay. With the others in the top 10 being Meta, Google, EA, Verizon, Take-Two Interactive, Disney, and AT&T. Now, if that top 10 sounds like a list of companies you can get behind, then please look into it. Check out the other 16 companies on the list to help you better make a decision on whether or not this is something that you would be interested in investing in as an ETF. And the last thing I'm going to say about XLC is that it is also the only ETF out of the three that I am naming here today that has shares of Paramount within its portfolio. So keep that in mind. So really, it could go. It doesn't matter if it's Netflix or Paramount. XLC, I believe, will benefit greatly. Okay. Second stock is FDN. This one has nearly double the amount of holdings that XLC has, with their top 10 being a lot more diversified between communication services and technology, right? So with FDN, you get Amazon, you get Meta, a substantial position in Netflix, you get Google, you get, I believe, Cisco Systems is in there, you get Booking Holdings, Arista Networks, and I think DoorDash is at number 10. Let me check that to make sure. FDN Holdings. Yeah, Salesforce, Booking Holdings. Yep, DoorDash is at number 10, right? Which, I got to say, DoorDash being number 10 is enough for me to think twice about this one, because I have my reservations when it comes to DoorDash stock. And for good reason. But nevertheless, you can see that there's a lot more diversification. If I slide up to this chart, you can see that there's a lot more diversification here with this ETF with a hefty amount of exposure to Netflix. So this fund will likely also be affected in the same ways XLC will be, except it will be a lot more impacted if Netflix stock surges at some point in the near future, right? Because a big position of theirs is Netflix. Again, you'll see it is there at number 3 on their list by weight, right? And the last one that we're going to talk about is GGME, which has its focus split a little bit more equally between both the communication services sector and the technology sector. Go back here and go over to their holdings. Okay, so you can see their top 10 include Apple, Nvidia, Netflix at number 3. Yep. Meta, Adobe, Qualcomm, AMD, and then you got Spotify and Nintendo and MediaTek also among their top 10. Okay, so a lot of this does have a lot of consumer discretionary. They have a little bit in there at 5%, just under 5%. But you can see the majority of this stock is centered around technology and, again, communication services. Now, of the three, XLC has the highest dividend at a little over 1%. Okay, FDN does not pay a dividend at all. And of the three, GGME is the most tenured with an inception date that goes all the way back to 2005. And XLC is the new kid on the block with an inception date of 2018. So that's where the drawback comes in for me with XLC, because there's not a ton of history there to go back and look at and analyze as far as its performance goes. 2018, we talking only 7 years, y'all. 7 years is not a long time in the market at all, especially when you have a company like GGME right here, which is an ETF that's been around since 2005, right? Huge difference as far as history goes. Now, if I had to choose one out of the three of these to invest in right this very moment, and I'm not choosing Warner Brothers stock itself to invest in, it probably no doubt be XLC, y'all. XLC, in my opinion, stands to gain the most no matter which way this plays out, because it has both Netflix and Warner already in their portfolio, and because I am a dividend investor, XLC's 1% dividend yield, although small, it's still more attractive than the others from a dividend investor standpoint because, the potential benefit from both price stock appreciation and dividend growth is there with XLC, in my opinion. Okay. Now, let me give a little bit of my input on how I feel as a consumer about this possible merger, because we also got news that, of course, Paramount is in the running. They have entered the chat. They are throwing $108 billion on the table to basically one-up Netflix and hopefully snatch this IP. I don't know which one will happen. Netflix seemed like they already had this deal ironclad, well, not ironclad, but just ironed out, and it seemed like the specifics of it were done. Whatever deal ends up going through, I think we have a situation on our hands that may not necessarily be great in either outcome. The reason I say that is because when you have a merger like this, there are a lot of things that can happen and probably will happen. There's an article I pulled up here, and I'm just going to read a small paragraph out of, or two. It says the executives reassured staff on their commitment to maintaining theatrical releases for Warner Brothers films. They also asserted that there will be no overlap or studio closures. Sorry, I don't believe that. I do not believe that there will not be a reduction in staff, y'all. I don't believe that at all. It said the co-CEOs further stated that the deal is about growth and that the company is strengthening one of Hollywood's most iconic studios, supporting jobs, and ensuring a healthy future for film and TV production. Despite these assurances, the Writers Guild of America, the WGA, has emerged as a vocal opponent of the acquisition, arguing that it violates antitrust laws designed to prevent monopolies. And that word monopoly is the exact word that I want to talk about for a couple seconds here. I think that it's very, very dangerous going into these types of waters where we are merging companies with a storied history like these two. Okay. Now, every decision that is being made by someone else. So your team might have had the right of way to go ahead and work on that new project, that new movie idea. Guess what? You had the green light before the deal. Now, if the deal is done, you got to run that by senior execs now. Monopoly is the exact word that I would use to describe what I think is happening here in the media space and why I think that this will not be good over the course of the media presence's future and for the consumer. Do not be surprised if you start seeing, if this merger happens with Netflix and you start seeing membership packages and prices upwards of $100 or more, y'all. I don't think this will be good on the consumer side. I certainly don't think it'll be good on the competition side, because competition is great, and I think it's needed, especially in the media space, because it forces you to try your best. It forces you to evolve. It forces you to grow. It forces you to move along. It forces you to go out and search and look for new talent, new ideas, and bring them in and try new things. This, to me, in my opinion, takes a lot off the board. But that's long enough for me. If you made it this far, I appreciate you. Drop a comment down below. Let me know what y'all think about this merger deal. Let me know where you stand on it. Let me know where y'all stand. Hope you enjoyed the information. Hope y'all put it to use. And I'll see you on the next one later, y'all.